Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
62 of Real Talk. Over the last 6 weeks, if you've noticed, I haven't released any podcasts. I've been busy enjoying the end of summer and the start of the school year, and a little work has gotten in the way, which is a good thing. The transactional market has picked up significantly. In fact, it's been busy over the last 3 to 4 months. We've been active closing deals, multifamily deals in the Inland Empire, in Washington State, in Ohio, a preferred equity mixed use deal in Washington, D.C., an industrial deal in Southern California, an office deal in Southern California. And as I look at my board here in my office, we have a pipeline of deals that are slated to close in the fourth quarter, making it likely an active quarter. And we're projecting an active 2025. Now, a couple of those deals were closed by Abacus Capital Group. And this week, I have Jeff Remillard, the Chief Investment Officer of Abacus, on the show, talking about how they've remained active despite, over the last couple of years, most multifamily owner-operators have been on the sidelines. Now, I do want to read a disclaimer that this interview with Jeff reflects the opinion solely of Jeff Remillard and does not reflect the opinion of any investment advisor, that past performance is no indicator of future results, and there is no guarantee that the investment objectives discussed will be met. Now, with those disclaimers aside, I hope you enjoy my conversation with Jeff Remillard. Hello, welcome to another edition of Real Talk. I'm here with my good friend, Jeff Remillard, Chief Investment Officer of Abacus Capital Group. Jeff, how you doing today?
Not too bad. How you doing, Andrew?
I'm good. Well, based on your view and sort of my view, it's another beautiful day in Los Angeles, and thank God the 100-degree days are over, and it's back to what, 75?
Absolutely, but we started the day with a 4.7 earthquake, so that was a good way to wake up today.
That's right. I was on my Peloton, and I got an alert that there was an earthquake, and I thought it was just me, really cranking hard at like 300 watts, and I caused it. So a lot of commonalities, Jeff. Obviously, we do attorney-client relationship, friends, and we were also co-office mates. You were in our office sort of at the beginning of Sklar Kirsh and the early years of Abacus. So
absolutely, yeah, early years of Abacus, West Coast at least, yeah.
Right. So for those of my audience who may not know Abacus, why don't you tell us about the company?
Absolutely. Yeah. So the company was started in 2004, so 20 years in business at this point. Historically, we've invested through a series of discretionary funds and separate accounts. We have a national platform, so we'll invest everywhere from suburban Boston, suburban LA to West Des Moines, Iowa, and Santa Fe, New Mexico. So pretty broad outlook, but all we do is multifamily housing. We don't stray from that at all. I think we've got a few ground floor retail spaces in some of our deals, but we give zero credit to that. So pretty boring, pretty pure play multifamily.
Yeah. Now, my audience is probably bored with me talking about the last couple of years, how it's been a choppy market, slower transactional market, but of my clients who have been relatively more active, you're probably at the top of the list. So how have you guys transacted in the market? And I want to talk about, what's going on now, but let's start with like over the last 2 years. How have you been able to transact more than others?
Well, we were very active both buying and selling, kind of in 2021 and then going into 22. Started to see the market turn. So we pretty much did put the brakes on for a while, both as a seller and as a buyer. We never fully put the pencil down. We always continued to underwrite deals, but it was clear that the market was starting to reprice and things just didn't really make sense anymore. So we certainly did take a pause. But again, it wasn't for lack of effort. We continued to stay on top of the market. It just, things didn't feel right. So, at the end of the day, we ended up taking about an 18-month gap on sales, and really actually have our first deal set to close in about 30 days on the disposition side. First deal in 18 months, and then on the buy side, as we progressed through 2023, you're never going to call a complete bottom on the market. And it didn't feel, like fully green light, buy everything you can. But again, we weren't sure that we're going to ever call the bottom of the market. So we continued to underwrite deals all over the country. We spent a lot of time doing research on markets that are healthy from a supply perspective, from an operations perspective. And ended up, over the course of 23, getting a handful of deals done. They didn't always feel, again, there were certainly nerves going into it. We weren't high-fiving around the table, but we felt like we were, making solid real estate investments, getting deals at a great basis, getting deals at a good yield. And we never strayed from, look, while rates were up, we still continued to have elevated exit cap rates in our deals. And, we weren't assuming outsized bounce back in rent growth. And again, we looked at a lot of deals and we missed on a lot of deals, but we were able to, to successfully complete a few in 2023 while the market was not feeling well. But again, vast majority of our deals had positive leverage, great fundamentals, good basis. So we always stuck to the fundamentals, and again, we're able to buy a few deals for that. And then as we've come into 2024, the bid ask between buyer and seller seems to be continuing to narrow, and we've continued to underwrite a lot of deals and have been able to have some success just by being early and being out there and being present in all of our markets, and being in front of sellers and brokers.
Right. So the deals that you did buy in 23, especially, it sounds like, hearing from experts that they're calling the bottom of the market the fourth quarter of 23, maybe the first month or two of 24. How would you compare the cap rates that you bought those properties in 23 compared to if you were to buy that same property today? So, 9 months later, 12 months later.
We tied up two deals like November, December of 23, both of which you are very aware of and your firm worked on, that in retrospect feel really good, but at the time were very nerve-wracking. If you'll recall, rates had spiked again. And there was really no one else. There were not a lot of other people at the table looking to buy at that time. So I do think, those particular deals do feel like pretty good buys. I would say, one of them in particular, I would say today, if the market's probably 75 to 100 basis points lower on cap rate for that particular deal. So feels pretty good now. Felt okay at the time.
Yeah.
But yeah.
What feels more uncomfortable in 2021 or early 22? You're competing and winning a bid against 36 offers or buyers and wondering, wow, did we just really overpay because we just were number one compared to 33 or 36 buyers, versus we're the only one bidding and we are now the owner of that property?
Yeah, look, strength in numbers, man. We felt fine when the market still felt like it had some good legs, and it was a lonely place, in 23 and early 24 when you're like, again, there were some others that made some good buys in 23 in 24. Yeah, I mean, it was a small group of us that were actually out there buying, and it was look, it was nerve-wracking, but it felt like the right thing to do. And again, we were not adjusting our assumptions to like bet for some rebound, bet for rates to dive in the future. We said, all right, if this is the new normal, rates are elevated, we might be buying at a 6 cap, but we're not going to assume we're exiting at a 5 to make this deal work. We're going to still hold ourselves to a higher exit cap, assuming that rates don't tick back down. And that's how we were able to. It was very uncomfortable buying in those times, just because we were more alone, but that's how we got comfortable with it and felt secure that we were making the right choice.
Yeah. Now, over the last 2 years, for my clients who rely on joint venture private equity capital, it's been challenging because for the most part, they've not been open for business, right? They'll listen, but when push comes to shove, they weren't doing deals, and it's still they're not doing deals in bulk yet. How does Abacus capitalize its deals from the equity side?
Yeah, so the vast majority of our deals are capitalized on the equity side through a series of discretionary fund vehicles. It's pre-raised money, so that when we go out, we have discretion over what we're buying. We don't have to go raise the money on a deal by deal basis. Actually, when Abacus did get started, the first 3 years of existence, they were project financing deals, but in 2007 got into the fund management business, and since have done the majority of our deals in these commingled discretionary fund vehicles.
Mm-hmm.
Yeah, and then we typically lever our deals as well, and a lot of what we do is with the Freddie and Fannie government agencies.
Sure. And with a 10-year, gosh, what did it top out at? 4.7, 4.8 in 23. You guys were still able to find positive leverage because the cap rates were
high. Yeah.
Were high.
Yep. We found some motivated sellers, and and at that point, again, you don't know if rates are going to go back down, so you need that higher cap rate. You need to put that higher cap rate in your exit as well.
So from our firm's perspective, people always ask us, they try and get a barometer. If the transactional law firm is busy, well, then that is one of the indicators of the health of the market. And I would say, usually there's a summer slowdown, but not this summer. The last 60, 90 days, the summer months, things were active, and they were the most active 90-day period over the last 2 years. And as we were heading into the fourth quarter, I look at my board here of our open transactions and a couple of recently closed ones, which I want to talk about. But things have noticeably gotten busier. What do you attribute? I guess my first question is, do you agree that there's just more players, more opportunities, more transactions, and what do you attribute it to?
Yeah, so at the start of the year, there were a lot of groups that were talking about getting busy again, saying, they felt like this was the year that they were going to get active again. But in the bidding, it's sort of, you didn't really feel it that much, kind of the first 4 or 5 months of the year. But absolutely, we've seen in the last 2-3 months just a noticeable difference in buyers getting off the sidelines, people getting more active again. And I think the biggest component of that is, it feels like, we may have reached a peak in rates. They're starting to settle. Rates are starting to come back down. There's less of again, it was scary parts of 23. Were rates done going up, or were they gonna, were they gonna keep going up? I think finally buyers and sellers are at a point right now where they're saying, they rates appear to have settled. So as a seller, I'm not selling when rates are at a high. I'm not selling, 3 months before there's some massive interest rate cut. So sellers are getting more comfortable disposing of assets now, and buyers are feeling more comfortable jumping back in, knowing that in due diligence they're not going to be, tying a deal up and then having rates move 25 or 50 basis points on them in the wrong direction. Yeah.
Can I play devil's advocate that as the 10-year treasury has gone down significantly over the last several months, and we're now, as we're recording, in the 3.6 range, I think it may have just ticked under 3.7. So it went up a little today, that sellers may feel like, why am I selling today? And with a Fed meeting coming up next week, that perhaps they were initially thinking they had to sell because they had expiring debt, and now maybe sellers are trying to hang on to their properties if they believe that rates are going to continue coming down, and could there be actually less or fewer transactions in the future because sellers want to hang on to their product?
I mean, I think I'm not sure how much people think, rates are going to dive like the long end of the curve, where you're looking at, 5, 7, and 10-year debt. I mean, it's the short end that really needs to come down. A lot of people's expectations are maybe even built into some of that longer end at this point. So, I do think sellers are comfortable that, yeah, maybe the short part of the curve is going to come down a lot, but I don't know, if people are betting on a major, overall, like that the long end is going to come down a lot more. But on top of that, what you have to also realize is, as I said, we didn't sell anything for 18 months. This is a transactional industry, and you've got, various funds and loan maturities and things like that. So there is a lot of pent up, I think, demand because so few transactions took place in 2023 and early 2024 that, a lot of sellers have to make up, for some lost ground and start to move products. So, I mean, all indications that we're seeing is transaction activity has obviously picked up. And we feel like that does appear like it's going to continue, in the near term. We're hearing a lot of talk about, broker BOV activity being up, and, there definitely being some action going into the end of the year.
Yeah. Now, it's a rare occurrence that I have a podcast guest who closed not just one, but two deals on the same day as recording a podcast. So, to the extent you're able to talk about these two transactions, tell my audience, what did you close today?
Sure. Yeah. So it was from the two transactions from the same seller. It was part of a larger portfolio. One of the deals was located in Corona, California, and the other one was in Everett, Washington. They both target a middle market renter, which is the vast majority of our portfolio. We want to make sure that that things are affordable for our renters, and we rarely are chasing after that very high end of the market luxury product. The particular deals have been owned by a group that wasn't based here in the U.S. They'd owned them for a number of years as part of this portfolio. And we felt like they had done a decent job with them, but both deals could use a little bit of a refresh on the common areas, and particularly the Southern California deal. We happen to own another asset about 5 minutes away, and we're just very aware of what's going on in that market. It's got a really strong fundamentals, lack of supply, and rents are really growing strong out there. So. We were able to capitalize on that as part of this transaction. And in fact, both of these deals, both suburban Seattle and the Inland Empire aren't suffering from oversupply like other parts of the Sun Belt are right now. And those are just some of the areas that we've been more active of late. These areas of the country that just have better fundamentals right now. We've done deals this year. Suburban, we're working on a deal right now in suburban Washington, D.C. We closed a deal up in the Northeast earlier this year. We're working on a number in the Midwest right now. Still like the Sun Belt long term, but the fundamentals just aren't there for us right now with all of the supply. So yeah,
I was gonna touch upon that. Most of 21 and 22 the vast majority of our transactions were Sunbelt, Vegas, Phoenix, Texas, Florida, Nashville, and the transactions we have been doing over the last 12 months have now returned to Pacific Northwest, California, but the strong markets within those states. So there's still a lot of groups that are afraid of Los Angeles and San Francisco and downtown Seattle, but not the Inland Empire, suburbs of Seattle, Orange County, etc.
Correct. Yeah. No, we've been, again, spend a lot of time doing research of across all of the markets that we're looking in, and certainly haven't abandoned the Sun Belt. In fact, we closed on one in a deal in Florida a few weeks ago, and are looking at some more stuff in Texas right now. But it's highly specific about what submarkets we're in, and what product type. Again, trying to find that middle market tier, not going after that luxury segment where there's been a lot of supply. So yeah, it has been an interesting shift in the market, but there's certainly still groups that are buying in the Sun Belt right now.
Sure.
Yeah.
And what are you able to talk about the in-place cap rates that you bought these deals at?
I can just say that just speak a little bit more globally about what we're seeing, because it's a pretty broad, we've bought some, some maybe slightly less institutional size deals recently, call it sub 40 million for, from maybe slightly more motivated groups at higher cap rates, kind of six plus. And then, some of the more institutional product seems to be, converging around a 5 today in the market. And a lot of what we've been successful buying are deals kind of in the, between 5.25 and 5.75.
Yeah.
But again, it depends on, what the dynamics are in that particular submarket, and what the profile of the real estate is, what's the vintage, and is there a large loss to lease there, so we can afford to pay a lower cap rate because, the operations are going to go up quite a bit in the near future, or is it a slower growth market where kind of we need that higher going in cap rate?
A lot of the capital providers that we work with have been focusing on quality and newer vintage assets. And so my sponsor clients who are looking for capital, and they're buying, 80s construction or really early 90s construction, they're having a tough time finding capital. If you have your own discretionary fund, if you're targeting assets that are in that older vintage 80s, 90s, are you seeing fewer competitors, fewer bidders, because a lot of the equity shops have turned away from that type of product?
Yeah. And again, I will say we do look at it all, and we are finding opportunity, in the 80s vintage stuff as well as the early 2000s right now. But yes, some of that 70s, 80s product that had a significant amount of bidders previously does have a thinner buying pool at the moment. But and for us, it's really just submarket specific. Where do we still feel comfortable owning some of that? So again, some of these more supply constrained, coastal markets, you feel a little bit more comfortable buying a 70s or 80s building, where the incomes of the residents are still pretty high in the area, and the home values are still pretty high. Whereas buying that same vintage building, in parts of the Sun Belt, just might lead you to a different renter profile, as well as just different profile versus home ownership and new supply.
Yeah, I get it. So what, taking out your crystal ball, looking at the next 12, 24 months, what are you focusing on, and what do you hope to accomplish? If we did a sequel to this podcast 2 years from now, it'll be a successful 2 years if what happens?
It'll be a successful 2 years. We'll continue looking at all of the markets that we're in right now. As I noted, coastal markets and parts of the Midwest are doing pretty well right now, but we still believe in the Sun Belt long term. So I think it'll be very successful if we're able to continue buying, in those coastal and Midwest markets. But that, I think some point over the next 6 to 12 months, I think the supply is going to start to dip back down in the Sun Belt. And I think there's going to be more opportunity that's easier to underwrite and comprehend, better fundamentals, in the Sun Belt over the course of, let's say, more like the next 12 to 24 months. And on top of that, hopefully we'll be able to continue both as an active buyer and as a seller, given that we've been a little bit more quiet as a seller.
Yeah. Now I want to pivot the conversation in our remaining minutes, and you're Chief Investment Officer of Abacus, but how did you get there, right? So what did you do before, and what was your road to getting to where you are now? Some of our listeners are younger, they're graduating college or masters, and they're starting their entree into real estate, and they're always curious of people's career paths.
Sure. Well, I got my first taste of real estate in high school, or just growing up in general. My grandfather owned some working class apartments back in New Hampshire, a few units, and my brother and I both, as a summer job, were maintenance guys there. Pretty unglamorous stuff, but nonetheless gave us a taste for the business. But out of college, I focused on finance for a few years just to get a good foundation, but was pretty hooked on real estate probably about a year into my first job out of school, and just spent as much time as I could, reading, studying the industry, learning who the players were, trying to make connections and reach out to people. And spent the early part of my real estate career working in development. Spent some time in New York City working in the condo business, and did some rental development deals. And then, after working for a few different developers, ended up, connecting with Ben Friedman, who's the founder of Abacus and our current CEO. And just spent probably a year or so getting to know each other, and ultimately they were looking to open up a West Coast office. The stars aligned, and it's been a great relationship ever since. So, I would say the reason I found out about Abacus was because I was spending a lot of time, reading about the industry and noting down, people in the industry that were working on deals that I thought were of interest. And I saw one and reached out to Ben and continued to follow up with them. And and it worked out. Yeah.
Yeah. This is a period of time, when there's choppiness, where there's movement in the profession of people, changing jobs, trying to find jobs. For someone that's starting out, what do you recommend as to how to start, or if there is a particular place in the business, whether it's broker side and principal side, development side, operational side, that you think is just the best to give that foundation bedrock for a real estate professional's career?
I mean, I think at the end of the day, it's all, try to figure out what you really want to do. Whether it's residential or industrial. So if you can have a something along those lines, it's good to know that, but not critical. I mean, I think at the end of the day, it's just important to get in and get experience. And the more you can see and the more you can do, the better. So if you're working at a brokerage firm that does a significant amount of deals every year, or you're working at a private equity shop where you get to underwrite, 100 deals in a year, hundreds of deals, I think that's a terrific way to start out. Just embrace it all, learn it all. You've got a long time to kind of build your career. So, just get in and try to get as much exposure as you can to as many different projects and deals and aspects of the business as you can.
Yeah, no, that's great feedback. And by the way, I know Abacus is the way you guys think about deals and think about the real estate industry goes. Your reputation is stellar. But I'm actually so really remarkable of how you guys think and communicate internally within your company. And I mention this because you are the only client who asked me to come into your offices and literally dissect a purchase and sale agreement for your whole team. I think we had about like 10 or 12 people there.
Yeah.
Some were like fresh out of college. I think some were made interns, and really to go through a purchase and sale agreement and what to look for. And no other clients ever asked me to do that. So I just found that just really remarkable of how you take a vested interest in the personal growth of your colleagues.
No, we're lean over here, but we've got a really great team, and we want to see everybody continue to grow and learn. And that was great. Thank you for taking the time, by the way, to come over and do that. That was a great.
Please.
Yeah.
And anytime I can speak for 3 hours, and then that's I can't do that at home. But
no one fell asleep. You did well. Yeah.
Yeah, we had to give some uppers to people.
Yeah.
No, but look, Jeff, I really appreciate you coming on the show, our friendship and professional relationship, and much success not only to the 2 deals you closed today, but to the whole company for the future.
Great. Well, thanks for having me on. Appreciate it.
I appreciate it, Jeff. Thank you.
Bye. Thank you.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.